What's up, everybody? This is Carlos Munoz from Guild Mortgage, doing another video series again. Wanted to talk about some of the different programs that we offer. Kind of want to do kind of like a mini little seminar about first-time home buyers and home ownership. So hopefully this doesn't take too long, but I think this is all very important information, especially if you're considering buying a property in the near future. I think this information is going to be very, very helpful to help you make your decision and kind of get more informed about the different programs that I can offer and the different types of loan structuring that I could do. So, with that out of the way, let's get started. So, I want to start off with this first slide, the 6 financial benefits of owning a home. So number one, this is just for somebody who maybe hasn't really looked at the benefits at all of home ownership, but number one is equity. So whenever you buy a property, you're essentially, it's an asset that you're holding and it's going to grow in value and you are going to be building equity from it. So every rent payment that you make right now is essentially what you're doing is you're increasing the equity for your landlord's equity in the property that you're renting. Meanwhile, when you have your own mortgage, you're essentially building equity for yourself. One is by paying down the principal that you owe on your loan, and second is you're building equity in the appreciation that you're getting in your property. So a lot of the times, individuals, they take out, they do cash out refinances. You can take a home equity line of credit. So essentially, this is all money. Even though that you're paying, it feels like you're paying rent, it's not really rent. You're actually paying yourself in the long term. So just keep that in mind. Another reason is a financial cushion. So your equity can be tapped for anything for home improvements or college tuition. Like I said, we do have a lot of clients that do, for example, cash out refinances, and they essentially take money out of their equity and they can use it to pay down debt or pay student loans or home improvements, etc. So again, it's just another, I guess you can call it another type, like a bank account where you can take out money if you were to need it at some point. So that's another good benefit of owning a home. The third is potentially lower monthly housing costs. In some markets, your mortgage payment could be lower than your rent. So yeah, right now with rent, especially here in San Diego, rent prices have skyrocketed, and in some cases, owning a mortgage could be cheaper than paying rent. It's not really in all cases because a lot of the times when people are buying a home, most of the time they're upgrading in size. So, for example, you could be renting I don't know, $1,000 room or apartment or whatever, and you're qualifying to buy maybe a condominium, something bigger. So most likely you are going to be paying more. So that's something definitely to kind of get used to and kind of, uh, you know, accept. But ultimately, like I said, even though you are making a higher payment, you are paying yourself. You're not paying your mortgage, your landlord's mortgage. And the biggest thing is to communicate, especially with your loan officer, is letting you know, well, how much do you want to pay in the mortgage? Because what we don't want you to experience is payment shock and be stuck with a mortgage that you can't really afford. So it's always important to have those conversations with your loan officer. So appreciating value. So I already kind of touched up on this. So your home can increase in value over time, building your equity and increasing your net worth. So exactly. So as time goes on, your property will appreciate based on numerous factors. It could be, new developments, new schools, new parks around your area, and also the way your property is evaluated is by comparing the value of your home compared to other homes that have been sold recently in the area. So that's what kind of makes up the value of your home. Um, Tax benefits, number five. So you definitely want to consult with your tax professional. All I can tell you is that whenever you do buy a home, you can deduct mortgage interest and property taxes from your income. So you will be getting a bigger return in your taxes. So, but again, I don't want to go too much into depth into this because who you really want to talk to is your tax professional. They're going to be able to give you more information. But there's definitely tax benefits involved. And last but not least, level payments. You'll never have a rent increase again with a fixed mortgage. Payments remain the same throughout the life of the loan. So typically, most mortgage payments are on a 30-year fixed term. So keep that in mind. Um, there probably there's a high probability that at some point in your life something will happen where you might have to refinance. You could do a cash out. So most people don't end up keeping their loan for the next 30 years. But in this example, if you were to keep your loan for 30 years, then essentially yes, you would have a level payment. It's not going to increase. Most people, what they, for example, if you buy your first home, a lot of people with a minimum down payment, for example, a lot of people will definitely refinance down the line, especially if you have the probability of getting rid of your mortgage insurance. So that's another great way to lower your mortgage payment in the future. So that's why I'm saying it's very unlikely for somebody to keep their loan for 30 years because at some point they're probably going to refinance to drop even lower their mortgage payment, or some people just need extra cash for improvements or student loans or paying consolidating debt. So there's always things that happen. So just keep that in mind as well. So that's our first slide. Second slide is just giving you an infographic here of renting adds up. So essentially just giving you kind of your total rent paid over years. So if you pay $1,000 in rent in 3 years, you're basically throwing $36,000 away in the trash. 120,000 for 10 years, 180, 360 for 30 years, and so on. So you'll see, you can see where you kind of fall along this bracket. And, if you were to wait 3 years, then essentially this is kind of the money that you're not really putting to use. On the other hand, if you were paying a mortgage, then this money would be used, not all of it. I mean, if your mortgage is, for example, $2,000, not the $2,000 is not going to be used to pay down your interest. Out of the $2,000, some of it will go to principal, some of it will go to interest, some of it will go for taxes and insurance or HOA. So but know that at least your money, you're paying down your debt, and you can always tap into it at some point, and you're just building wealth for yourself over the years. So that's another a good infographic to see how much money you are not utilizing in the best way possible if you are renting. Another really good chart here is what affects your credit score. A lot of clients ask me this question. Keep in mind, whenever I ask somebody, well, what is your credit score? They'll say something like, oh, well, my Credit Karma says this. Just know Credit Karma or any of those credit applications that tell you what your credit score is, they're not really giving you a credit score for a home purchase. They're giving you a credit score for like credit cards or auto credit. So just know whenever you apply for a home loan, there's different types of FICOs involved. So this graph here, this is for a FICO for if you were to buy a home. So 30% is actually, let's start here. 35% is your payment history. So the bureaus like to see the credit bureaus like to see the history that you have on account. So if you had an account for a long time, if it's a revolving or an installment, revolving would be more of a credit card. Installment would be something that you're paying down. So they like to see things that you have been paying for a long time because it shows that you are a strong person, a person who has strong credit because you are, you're living up to paying down that debt basically. So you're a good person that pays their debt on time. 30% is amounts owed. So the credit bureaus like to see that you have, well, it does impact, well, how much is owed, because sometimes if you have a lot of debt, that could potentially be bad. So there's always kind of a sweet spot to how much debt you should have. I can't give you a number because it differs per person and also per income, but that's another big indicator of one of the factors that affects your credit score. The other one would be length of credit history. So I kind of touched up on this. So you definitely, if you're an 18-year-old or a 19-year-old who's just establishing credit, then you may be getting dinged a little bit on your possible credit score outcome. So they like to see somebody who has a long credit history. 10% new credit. So this new accounts that have been open. So if you just got a credit card, it could potentially increase your credit. And your credit mix is that they like to see a difference of credits like revolving credit, student loans, or installment credit type of accounts. So all of these factors is what affects your credit score. Number one, you want to keep focus on are these two, your payment history and the amounts owed. So I will always recommend to put things on auto pay if you can. So because if you're late one time, it could potentially drop your score like 20 points, 25 points, and it could take me, a couple or to a few months to bring that score back. So lates can definitely affect your credit score in a big way. So keep that in mind. The next slide. And last, let me touch up on this. So another thing that could affect your credit score is collections. So be careful with collections. For example, well, if you have a medical collection, just know medical collections don't count against you when it comes to pre-qualifying for a home. They do, in fact, affect you in your credit score that you get. So just know, like, if you have a $5,000 medical debt, that's not something that I have to take into account when calculating your debt, but it could potentially affect your score, and you may not have the greatest score, the highest score that you can because you have this debt. Another type of collection that that you should definitely keep an eye on, and you definitely cannot have, is federal student loan collection debt on collections. If you have any student loans on collections, you are not qualified to apply for a home loan. So keep that in mind. Charged off accounts is another type of collection that you could have. It's just an account that the creditor has requested payback for a long amount of time, where they eventually charge it off. It means that they no longer are requesting to pay it back. That it doesn't affect you, but it doesn't affect you when it comes to qualifying for a loan, but it can definitely affect your credit score as well. For any other type of collection where it's, let's say, for example, it's I don't know, T-Mobile, and then another creditor takes over and it's on collections. That will, once you have over $2,000 worth of collections, then the rule of thumb is we take 5% of that and use it against you as debt. So keep an eye out on your collections because it's very important. Some of the stuff on collections can affect the outcome of your loan. So just wanted to briefly touch on that. Here's an infographic. We're going to start getting into different types of loans that we have available. So this slide talks about FHA, USDA, and VA loans. These are government loans. So just to give you an idea of, well, how much down payment do you need based on these loans is, well, if you do an FHA loan, FHA loans are known for being or have one of the lowest down payments and lower credit scores out there. So if you're applying for an FHA loan and you have a credit score from 540 to 580, you can apply for a home loan, except that you're going to need a 10% down payment. This is relatively new information. This was just updated, I would say, about 2-3 months ago. Before, if the lowest that you would be able to go was it kind of moved around. It was like 600, and then it went from 580, and then it went up again to 600. But now they came up with this new bracket. It's 540 to 580, 10% down payment. So if you have a credit score lower than 580, you definitely need to have 10% down to be able to qualify. The FHA loan, if you have from 580 and up, then the minimum down payment required is 3.5%. There's a misconception out there that you need 20% down to apply for a home loan. That is not true. You can get away with doing an FHA loan where the minimum down payment is 3.5%. So just keep that in mind. USDA are rural loans. So these are loans for properties that are located outside of the city. So to be able to qualify for these USDA loans, there is a map, and there's on the USDA website. So not every single home can qualify for this type of loan. The benefit is, it does have a low FICO score requirement, and it's 100% financing, 0% down payment. but just know that it's a little bit harder to qualify for these loans just because they're a little bit strict on ratios and other things. So, but it is a possibility if you are planning on buying, for example, in like Pine Valley area or somewhere out, in the desert, far away from like a major city like San Diego, or LA or anything like that, then you could potentially do a USDA loan. VA, this is our VA loans for military members and veterans. The minimum credit score for those is 540, and as you probably know, it's well known out there that if you are a member of the armed forces or reserves, then you qualify for 0% down payment. And so only these two loans, out of all the possible loans out there, these are the only two loans that you're able to go 100% down payment. There are exceptions, like there are some down payment assistance programs that can help you out with, covering the minimum down payment requirement. But just, if we're not even if we're not including those in this conversation, it's just these two. The USDA and VA loans are the only loans that you could do 0% down payment. So let's keep going. So a little bit on VAA. So it's 100% financing, like I mentioned. No mortgage insurance. That's a really good perk. But just know a lot of places advertise no mortgage insurance, but you will be paying something else called a service. What is it called? A funding fee, a VA funding fee. So just keep that in mind. First-time home buyers allowed, of course, 4% seller concessions. That means that only the maximum that the seller can help you out is 4%. In this market, you're not going to see that because we're in a really, really hot seller's market. Means that the sellers have control and they're able to get away with more when they're selling their home. So this would apply more if you were in a buyer's market. Here we go. The VA funding fee applies. This is what I was telling you guys about. So there is a funding fee that is charged. Typically, it's 2.3% for first-time users, and I think it's 3.6 for subsequent users. There will be changes starting 2022, so I'll keep you posted on those. I know the funding fees are going to drop. Credit score 540, as mentioned. There's high balance loans. High balance loan limits apply, so there are loan limits apply when it comes to high balance loans. And you could use this VA loan for single family residences, 1 to 4 units, planned developments, condos. Condos, they have to be VA approved. Not every single condo out there is VA approved. So whenever you are shopping for a home and you qualify for a condominium and you're using a VA loan, you have to make sure that the condos are VA approved. And manufactured homes is basically a home that was built uh, kind of in an assembly line type of situation, and they get moved to a permanent location and they're affixed to the land. A lot of people uh, confuse these with mobile homes. Mobile homes are a completely separate thing. We don't do loans for mobile homes. Mobile homes, you do have to pay rent for the space where your house is located. Manufactured homes, it's affixed to the land and it's real estate tax. That's the biggest thing. For VA, you can use VA if you're active duty or on reserves or a veteran. So just know that. And yeah, and if you have any questions, let me know. We do definitely do VA a lot here. So next one is conventional financing options. So this is just the more we're getting into the more typical regular type of loans that we see in most of the time. So conventional financing, you could do up to 97%. So that means that the lowest minimum down payment that you could get away with is 3%. You could qualify for that. You could use this for primary, second home investment purchase and refinance options. First time home buyers allowed, 3 to 6% seller concession. So again, this would only apply if you were in a buyer's market. Credit scores as low as 620. Something to note, especially when it comes to low credit scores. So the requirement says 620, but just if you're applying for a loan and you have a 622 credit score and you're barely making by, just know that your interest rate is definitely, and mortgage insurance are going to definitely be influenced by your credit score. The lower your credit score is, the higher the interest rate, the higher the mortgage insurance will be. So if somebody who has a 622 credit score, they might want to do FHA because in an FHA loan, it's going to require or it's going to have a lower interest rate, and also the mortgage insurance won't be as high. So that's why when you apply for a loan, the loan officer is the one who's going to be able to see which option is best for you based on your whole credit application and your income, your assets, and your credit score. So just keep that in mind. Flexible down payment resources, conforming and high balance loan limits apply. So let me touch a little bit on this. So right now, the conforming, so wherever you buy, depending on the county that you're buying, there is loan limits that are set by the county. So for example, if you were to do a conventional loan, the loan limit was 548 250. If you have a loan under that loan amount, then you would have just a conforming conventional loan. Anything higher up to 753 250, that would be considered high balance, and anything higher than that would be considered jumbo. There are new loan limits set in place right now. Let me actually find them. They just came out, so I don't know them memorized on the top of my head. So let me get those for you. So loan limits is okay, here we go. So starting in 2022, the loan limit is 625,000 for conventional. So anything under that, you are on a conforming conventional loan. Anything above that, from 625 to 822,375, then that would be considered high balance. And anything above that is jumbo. When I mean jumbo, you have to put in 20% down. There's no other way around that. There are programs we have here available that you could do 10% down, no mortgage insurance, 15% down, no mortgage insurance. But for the most part, like the majority of the programs out there, jumbo programs require 20% down. So keep that in mind. Riverside County is different. So if you are buying in Riverside County, loan limits are different up there. So it's very important to have your loan officer look at those loan limits and make sure that you fall in the adequate either conforming or high balance. At this point, there's it differs a little bit, I guess, on interest rate and other things. So just have your loan officer be aware of where you're buying. Property requirements. You can use this loan for basically almost anything. Single family residences, 1 to 4 units. Planned unit development, condos must be Fannie Mae or Freddie Mac warrantable. So again, whenever you do a condo, it's a little more. There's a little more extra work that needs to be done. Whether you use conventional or FHA. FHA, we have to make sure it's FHA approved, or if it's VA approved. But there's also HOA questionnaires that have to be done to make sure that the condos are warrantable. So that's another thing. Manufactured homes, again, you could use this loan for a manufactured loan as well. Let's move on. This is the USDA loan that I was telling you guys about on the rural area. Get up to 100% financing, no money down. So our USDA guaranteed rural housing loans offer unique options for eligible properties in a wide range of non-metropolitan areas, including main suburbs. Finance up to 100% of the market appraised value. Loan amounts up to $765,600. Available to low and moderate income borrowers, first-time home buyer allowed, flexible sources of fund allowed, and credit score is 540. So again, if you are interested in buying something out, in the desert out there, Pine Valley type of situation, then let me know. You might be eligible to do a USDA loan, but just know that it is more strict. It's a little bit harder to qualify for a USDA loan. So just because you're buying something out there does not necessarily mean that you'll qualify for a USDA loan. So keep that in mind. There's a lot of things to look at. So, but you can definitely express interest and we'll find out if you qualify. Another type of loan that we offer that is very, very popular, and I think not a lot of people actually use it and should. It's our FHA 203K renovation loan. So if you were to buy a home, let's say, I wouldn't call it distress home, but let's say you buy a home that maybe you need a little bit of paint and you want to do the kitchen and you want to redo a bathroom, you could do something called a 203K loan, which means that they'll finance the renovation costs on top of your loan as long as after the renovations that appraises for the amount, including the the remodel. So what that means is basically if you have a house that is 500,000 and you add a kitchen or remodel the kitchen, then that's gonna add $30,000 worth of value. This is just an example that's not true, but let's just say that it adds $30,000 worth of value, then that property has to appraise for $530,000. These type of loans, we do the early, so we do the pre-qualification and get all the documents from you and do the pre and do everything. But if you are interested in doing a loan, a renovation loan, we send this off to a renovation expert that we have here in Guild, and then they're the ones who will take over that loan. But it's definitely doable. The benefit of this is that it's minimum down payment required. So let's say you don't have money to fix the kitchen or add a bathroom or whatever, you could do 3.5% down of the appraised value. And then what the bank will do is that the way it works is that whenever you have to consult a contractor to get some estimates on how much things are going to cost. And then once the transaction closes, there's going to be a separate account established for you, and that account is going to have all the funds that you to pay the contractor. So they're gonna distribute the funds out of that account. And some of the things that I have here, for example, so for the FHA 203K, the government renovation loan is a good option if you're planning on a larger or complex project that you need the flexibility of a down payment. So there's two types of renovation loans. There's a limited renovation loan that's limited to, I think, $36,000 of renovation, and there's a full one. So keep that in mind. Just depending on what you're trying to do, there you could do a regular 203K or you could do a limited. So the limited is a good program if you want to make minor repairs, like cosmetic improvements, new flooring or appliance upgrades. So it's designed to finance projects that can be completed quickly and easily. So there's that. And yeah, so if you are interested, oh, another thing too, you could use these loans to build an ADU. So an ADU is an accessory dwelling unit. A lot of properties, especially in the Chula Vista area and Spring Valley, and there's areas around town that have really big lots. If you have the room to build what they call a granny flat or accessory dwelling unit ADU, you could use these programs to finance these projects. So that's super super useful. I know the city has been becoming less or they're becoming more lenient on the permits and stuff like that. They're encouraging ADUs to be built to help with the lack of housing inventory in San Diego. So this could be a great way to have an addition to your property and collect rent from it. So if you are interested in something like this, let me know. We can definitely talk about it. Um, so this was the FHA. There's also a conventional. This is a conventional renovation loan. So this loan offers the most flexibility in the terms of which renovations are possible. So this would be more for like luxury improvements like home theaters and swimming pools. So if you wanted to go all out and just have your house totally redone from bottom up, we could talk about doing something like this, a conventional renovation loan. Minimum down payment is as low as 3%. Some of the types of improvements that you can do in this type of loan is for health and safety reasons, livability, structural repairs, luxury items. So yeah, absolutely. If you guys are interested in doing something like this, let me know. This is just another tool or another type of loan program that you could do that a lot of people may not be have known about. So look at accessory dwelling unit eligible. So you can use this type of loan to build an accessory dwelling unit. Um, let's move on. So now we'll get into the down payment assistance programs. These are some of the programs that I love to promote because it helps uh, potential buyers get into homes. So a lot of the barriers to home ownership One of the biggest ones is not having enough money, and just with just the way the economy is and times and COVID and just everything that has been going on, it's been super hard for people to save money. If you're trying to save up for a down payment, it could potentially take you a year, 2 years, maybe even 3 years, depending on what you're looking for. So it just takes an exorbitant amount of time to save money, and these programs are designed to help you with that money, so that way you can get into a home and start building equity for yourself and wealth for yourself. So let me start off with this one. This is through the California Housing Finance Agency. And this program is called the Cal Plus with SIP. So this program, the way this program works, it's a 3%, it's 3% of the loan amount of assistance that you would be getting for closing costs. So it's up to 3% of the first mortgage loan amount in a deferred payment junior loan. So what does that mean? That means is that you're going to have your main loan, you're going to have a secondary loan, which would be this one, the ZIP, which stands for zero interest program. So there's no interest on that second loan. There's also no payments on that second loan. But something to keep in mind is that this does have to be paid back whenever you refinance or whenever you sell your property. So it's a great program, especially for someone needing help with down payment, or I'm sorry, with closing cost assistance. Uh, the next program I'll go over is called the My Home. And the reason, and these two are connected. We 99% of the time we structure the ZIP and the My Home program stacked. So you're using two down payment assistance programs because it helps you out with the most amount of money. So remember, this is a 3% zero interest junior loan for closing costs, and the My Home program is up to $15,000 down payment assistance. So let's say you were to buy a home, and the down payment is $14,000 that you have to put out of your own pocket. This program can help you up to $15,000, so that means that you would get $14,000 because it's up to $15,000. If the down payment is $17,000, then they're only going to help you with up to $15,000. Here's the main difference. If you work for school employees, California public school system, if you work for a California public school system, you do not have that $15,000 cap. So what that means is if your 3.5% down payment is $22,000, you're going to get $22,000 in assistance. So essentially what they're going to do is 100% financing down payment assistance. Okay. So the difference between this one and this is another loan. So it's a deferred junior loan. So no payments on this loan. So you're going to have your main loan, second loan, which would be the SIP. Third loan would be the My Home. This one has no interest. This one has a 1% interest annually. Simple annual interest annually. So it's not like it's compounded. It's 1% every year. So it's not a lot of money. These two loans do have to be paid back at some point. So whenever you sell or refinance your property, 99% of our clients have been able to refinance their home in a period of 2 to 5 years. Last year was kind of a crazy year with home values skyrocketing, so some people were able to get rid of these loans in a year. So essentially what happens is whenever you refinance in the future, you pay these loans off on your refinance. So there's nothing out of pocket that you would have to pay in a refinance. You finance the loan amounts into your new loan amount, and that's how you would get rid of them. So this is a great program. Here's another thing. So remember I said California public school systems, California school employees, fire department employees also, they don't have that $15,000 cap. I'll touch on this a little bit later. If you buy manufactured homes, there is no cap. And if you buy new construction, there is no cap, or homes with ADUs. So there's plenty of options to not have that $15,000 cap. So super popular program. We use this all the time. So this program is one of our most popular ones. So I'll go on to the next one. So remember I mentioned earlier USDA loans. So with USDA loans, remember I said it's 100% down payment. It's 100% down payment, but you still would have to pay closing costs. So CalHAFA can help you out with USDA rural development. They can help you out with a loan to pay for it's a My Home Loan Assistance Program. And again, it's a deferred second mortgage that can be used to cover the closing costs. So essentially, if you qualify for USDA and you qualify for CalHAFA, you could potentially walk out putting near to zero money down to get your house. So this is just another option that you have, CalHAFA with USDA. And also VA. So with VA, 100% financing, VA members do have to pay some closing costs. There's a lot of things that get waived. You're not allowed to charge a VA certain fees. But for the fees that do have to get charged, you can get a VA CalHAFA, and you can have this program pay for all of the closing costs, essentially making almost near to no money down at all on a home purchase. So super helpful. Here's a little loan comparison I wanted to go over. So let's say you were going to do, we're comparing a down payment assistance versus no down payment assistance. So let's say your purchase price is $500,000. Your loan amount is $475,000. That's if you put a 5% down payment. And let's say we use CalHAFA, we use the $15,000 plus the 3% zip. So your down payment is 5% down. So it's $25,000, which is right here. Your down payment that you would be getting if you use the program is $29,250. Your closing cost would be about $20,637. So your amount due at closing would be $16,387 on a $500,000 purchase. So this is more attainable than if you were just to do a regular conventional loan, put your 5% down, no down payment assistance, closing costs, you would have to pay almost $40,000 just to be able to close on this property. A lot of people, I hear people say, oh, well, if you use the down payment assistance programs, it's more expensive because you pay higher closing costs. That is true, but even so, it makes sense, and it turns out way cheaper to go this route than having to go a regular conventional route. So, explore all of your options, have a consultation with me, talk to your loan officer to see which option is good for you. I always like to present down payment assistance program options, and I also like to present regular loan options. But what I heard somebody say before, what is the best loan out there? And the best loan out there for you is the loan that you qualify for. So just keep that in mind as well. But yeah, I like to give options whenever I give my consultations. I don't just present one option. I'll try to throw in 2 or 3 options out there, so that way you can make the best decision for yourself. Moving on, this is another program. It's another agency that we work with. It's called GSFA. It stands for Golden State Finance Authority. And this program is a great program. Oh, sorry. Before I continue with this one, let me go back on this one. The CalHAFA program, the minimum credit score that you need for this program is 660, okay? So if you guys are interested in qualifying for this program, you need 660 credit score. This program, the Golden State Finance Authority, Open Doors, the benefit of this program is that it starts at 620 credit score requirement. So this program can help you with up to 7% down payment assistance. The 7% is not always available right now. It's kind of been ranging between 5 to 6% down payment assistance. But if you look at this example, on a $300,000 loan, that's about $21,000 of down payment assistance. So this is a great program, especially for somebody who does not have the 660 credit score and maybe you have 620. You could go with this program. This program can be structured FHA. It can be structured conventional. So there's a lot of options out there. 95% of the time, we're structuring this loan in a FHA just because There's less guidelines, and there it's a little more less strict than if we were to go on a conventional. Um, so this program, this program, you don't have to be a first-time home buyer. You could apply for this. You can have a home already, and and use this program. The other benefit in using the GSFA open doors is that if you use FHA, you are allowed to have co-signers. So let's say you don't make that much money, your credit score is not that great, but your parents can help you out, then your parents can co-sign on the loan for you, and you would be able to qualify for this program. So that's another good benefit. You don't have to be a first-time home buyer to use this program. So we use it on time to time in these particular scenarios when somebody doesn't have that good of a credit score, and or they want to have co-signers or something like that. So this program can be used for its owner-occupied primary residence. So it could be 1 to 4 units, single-family residence. It could be a PUD, townhome, or condo. So a lot of different options out there. So yeah, this is another great program. The thing with this one, remember I said earlier, interest rates do play a factor in credit scores play a factor in interest rates. So because the credit score requirement is 620, the interest rates for this program tend to be a little bit higher than the normal. But again, if that shouldn't really deter you, because regardless of how you look at it, owning a home, it's always going to be better than renting, and you're gonna be refinancing in the future, and there's going to be a lot of options that you'll have at your disposal. So uh, another thing that I forgot to mention about this program, the way it's structured, it's half and half. So half of it will be a gift, and the other will be a second mortgage. So typically the way it's split is 2% gift and then the rest would be a second mortgage. So the gift is it gets forgiven at the close of escrow. So, if you qualify for let's just say you qualify for 5% down payment assistance. Let me see how that's broken up. Hold on. I have it right here opened up. If you have 5%, give me 1 minute. Sorry, I have a lot of emails. If you have 5%, here we go. Let's say you want to do 5% down payment assistance, then the way it's split is 3%, I'm sorry, 3% will be used as a gift, and 2% will be used as a second lien. So similar to the Calhafa program, the second liens do have to be paid back at some point, and that's when you sell or refinance your property. But that 3% gift will be forgiven to you at the close of escrow. So that's another good benefit. It's half and half, but the gift has a higher weight on the percentages. So I know I told you guys it was the other way around, but no, the gifts are it's 2% on the second liens typically, and whatever remaining, if it's 5%, then 3% would be a gift. So 3% gift, 2% second lien. If you were to do 4.5% down payment assistance, it would be 2.5% gift, 2% second lien. So just know there's a split somewhere in there. So this is called the open doors. The other program that we have, this is the Platinum program. It's through the same agency, Golden State Finance Authority. This program is a grant. Essentially what that means is money that is given to you. You don't have to pay it back. So this is another popular program. This program starts off at 660, but I recommend to have 680, because at 680, I am able to approve you for a higher amount. So the way this program works is up to 5% of the loan amount in down payment assistance. So they put this example here. You can qualify up to $10,000, but that's on a $200,000 mortgage, which is, you're not going to find that anywhere here in San Diego. So let's put a more realistic example. $530,000 loan amount, 5% of that would be $26,500 in assistance that you would be getting. So great program, super popular. The way this program works is it's forgiven. It's a second mortgage that is forgiven after 3 years of mortgage payments. So let's say you close your loan today, November, in this month, 2021, you'd have to wait until 2020, 24 to have this second loan forgiven. Now, if you work on my next slide, I'll explain that if you work on certain occupations, that you do not have to wait 3 years, and that money will be completely forgiven at the close of an escrow. So let's talk about that. So again, this one is 660 minimum credit score, 680 preferably. Now, let's talk about the Platinum Select. So this is a great program for people that work in these occupations. On my next slide, I have a more detailed list. But essentially, if you're working any type of these medical field, emergency, paramedics, technician, fire support, school, law enforcement, you will be getting this as a gift, completely given to you at the close of escrow, and you do not have to pay it back. So this loan, this GSFA loan, 99% of the time we structure it FHA for the same reasons. It's just not as strict on guidelines, and we are allowed to do more things. This program also allows you to have a co-signer, similar situation to the open doors. If your parents want to co-sign or somebody else wants to co-sign for you, then you are allowed to do that on FHA. So this is, let me go on the list actually here. So if you work for any of these qualifying occupations here, peace officer, sheriff, border patrol, correctional officer, firefighter, paramedic, EMT, and anybody in the members of the California State Teachers Retirement System or University of California Retirement Plan, then you qualify to get this as a gift. So super popular program. We use it a lot as well. Next is this program is called FHA. Oh, I can't type. FHA Zero Down, and it's through Chenoa, which is the agency that deals with this down payment assistance. This one has a 640 credit score. There's two ways this down payment assistance works. One is called the Advantage, and what that means is that you're going to have a second mortgage, and with all the other more down payment assistance offers that we talked about being silent second loans that are deferred. This one does have a payment, so you're going to have your mortgage payment, and you're going to have your second lien that you'll make payments on, and it's at 6% interest, and it's a 10-year term. So you could pay it off earlier if you wanted to. Benefit of this program is 640, and also the credit scores, the interest rates are not as high. But yeah, anybody who just needs money, and make fairly decent amount of money and confident that they can pay this loan back, in the short term, then you don't have to wait 10 years to pay this back. You can pay it back in 2 years or however long it takes. So, and it's very similar to having just a regular FHA loan. Interest rate's just slightly higher than a regular FHA loan, but this is the benefit of that. The other way it could be done is it's called Edge, and the Edge is a grant, basically similar to the GSFA Platinum program. It's a grant. The only thing about this program is that it has income limits, so you can only make certain amount of money. So I think the Advantage is 135% of the average median income, and the Edge is 115% average median income. I think the average median income in San Diego, I think it's I have to look it up. There's a chart for it, but it's different for this program as well. So, but just know that there's income limits, so it's a little more, I could say, a little bit harder to qualify. This one will help you out with, I forgot to mention this, but this program can help you out with 3.5% down payment assistance or 5% down payment assistance. So whichever you prefer, the 5% DPA is going to have a higher interest rate. That's for sure, versus a 3.5%. So just another option to go over. So 3.5%, 5% DPA, primary purchase transactions only. I think the one of the bigger differences on this program is that this program, I think, allows for duplex transactions. So that's another perk for this program. But yeah, this is just another program. So far, we have had programs in 620. This is a 640 program. We have 660 programs, and we have 680 programs. So You have higher than a 680 credit score, you basically qualify for any of the programs, and you'll have plenty of options to choose from. Now, this program is the program that helps you out with the most amount of money, but it's also the hardest program to qualify for. This one's through the San Diego Housing Commission, and this program can help you out with 17% down payment assistance and a $10,000 grant for closing costs. This program has a 640 credit score requirement that does have income limits, which I put right here. So what that means is it's income limits based on household. So if you have a family of four people, you cannot make more than $97,000 to qualify for this program. And they're going to take in mind every single person that lives in your household. Even if they're not applying for the loan, they're going to count their income. So if you have an 18-year-old kid who just started their first job in McDonald's or wherever, and is making money, even though he's not applying for the loan, they're going to take their income into account. So if you go over this $97,000 limit, then you will not be able to qualify for this program. This program is, there's a city program, there's a county program. We only focus on the city program just because we can go to a 45 debt to income ratio. It just means that you can qualify for a little bit higher amount, but you are, and also you get the $10,000 grant. This particular city program, you can only buy homes in San Diego County with zip codes 921, starting with 921. You cannot buy you cannot put offers on any properties that is not on this zip code. So this program is super, super difficult to qualify for. It's very strict. So we always like to see if our borrowers are a good fit for this program. We always explore this program. But just keep that in mind. It's super strict. They're going to ask for a lot of documentation because not only does it have to get approved by Guild Mortgage Us, it also has to get approved by the agency, and they have their own underwriting department. And they're going to want to see 3 years of tax returns, 3 months of bank statements. They're going to want to see everything about you. So there's a lot. It's very paper intensive, this program. There are maximum price limits. So if you buy a condo, townhome, the most you can buy in the sales price is $542,500. If you buy a home, the highest you could go is $783,750. But if you qualify for this program, I mean, man, this is such a good program because the benefit is, yes, they're helping out with 17%, right? But the minimum contribution for you is 3%. So 3 plus 17, that means that you're going in with 20% down. And if you put 20% down on a loan, you automatically have no mortgage insurance. So that means your payment's going to be really low. So again, let me just go over here some of the details. 640 credit score, income limits per household size, sales limits apply, zip code restrictions. There's restrictions on property. Like for example, you can't buy a property that's tenant occupied. There's like little things here and there that on the rules that you have to be aware of, like especially if you're a real estate agent. Home buyer education is required. Oh, very important. And I didn't mention this on the other programs, but some of the programs do require home buyer education. We can certainly talk about which ones do. It's just a class that you have to take. It's typically $100. This one has two of them. This one has a home buyer education and a home buyer counseling that you have to take. So it's just a little more that you have to do. This one does not allow co-signers whatsoever at all. So only the people who live in that house can qualify for the loan. Non-occupying, this is what I just said. Tenant occupied property is prohibited, said that. So this one, we recommend a 30-day escrow. With this market, there's, right now kind of the norm seems to be 21 days. But just if you are qualified for this program, just because of how paper intensive it is, we definitely recommend 30 days to be able to close on this transaction. All the other programs, down payment assistance programs, we can close them before 30 days. We've had 21-day escrows. We've had 25-day escrows. So just because you are using a down payment assistance does not mean that it's going to take a longer time to close. All of our files are underwritten in-house. All of our down payment assistance programs are underwritten in-house. The only exception that this one has to get approved outside of Guild, and it gets approved in Guild, but it also has to get approved by the agency, the San Diego Housing Agency. So this is one of the only programs that we do have to send it off for its own individual approval. So This is the San Diego Housing Commission. Um, and then this is just kind of a graph showing kind of all the different down payment assistance options that are out there. So there's zero down payment assistance if you're VA, USDA, or if you do FHA zero down or any of the other down payment assistance programs, you could potentially do 0% down. If you go 3% to 19%, you could do conventional loans. 3.5% down, that would be FHA. Credit score as low as 580, or you can go 540, but you have to go $10,000 in down, or I'm sorry, 10% down payment, 20% down conventional. This would be the more of the like the typical. That's how what people think that they need down payment, but you don't. The benefit is no mortgage insurance, um, down payment assistance programs. I went through a few of them, so just know that there's a loan out there for you. I mean, there's so many options out there. People just think that it's just this one. But yeah, I mean, there's so many things out there that you could qualify for. Here's another really popular question that I get asked a lot is people that have bankruptcies. So if you've had a bankruptcy in the past, whether it's Chapter 7, Chapter 13, the most common ones out there, you have to wait minimum of 2 years. If you do a Chapter 7, minimum of 2 years, minimum 600 credit score to be able to qualify for an FHA loan. If for a conventional loan, Fannie Mae, Freddie Mac, you have to wait 4 years. So a lot of people that have bankruptcies, the majority of the time, we end up doing FHA just because it's most likely has not been 4 years. If you do a Chapter 13 bankruptcy, it's a minimum of 12 months with satisfactory payout when court approval. So you have to show proof of the payout, and there has to be a documentation from the court. It's a little bit harder, or it's not hard, it's just more things that you have to do to meet this requirement. And then 2 to 4 years, I say 4 years because I have never seen anybody get 2 years from discharge date. It's super hard to get approved for two years from the discharge date. That's why I always recommend 4 years. But just know, I mean, this is just all the other scenarios as well. These are the most common ones. So if you've had a bankruptcy in the past, 2 years minimum from your discharge date, or 4 years conventional. USDA 3 years, VA 2 years as well. So here's the chart, depending on the loan that you want to use. Acceptable sources of funds. Acceptable sources of funds to close. Another very important topic. Let's say you only have $5,000 in your account. You're using a down payment assistance program. You still need a little bit more to close. Just know that you are able to get a gift from close relatives. So your parents want to help you out, your cousins, your uncles, somebody close to you. You can do a gift from a close relative to make up for that difference. So this is something that we see a lot, for especially somebody who doesn't have all of the money that's necessary. Cash on hand, not allowed. You cannot use cash on hand because of, it's not traceable money. You're not paying taxes on that cash, and just it's part of the anti-money laundering rules that were set. So you cannot do cash. So other things, so earnest money deposits, this is just a deposit that you'll have to make whenever you get your offer accepted. So obviously this money goes towards your total cash to close. Investment accounts, so 401ks, checking savings account, you can use those funds on there. Commingling of business and personal accounts, so it could get a little tricky here. So just talk to us to find out whether or not you'll be able to use your business account, your money from your business account. So business accounts are not always your money to spend. So that's why we have to talk a little more in detail about this. Stock liquidation. So if you have Robinhood, Fidelity, all the other stock brokerages out there, you could liquidate your stocks and use that money for the cash to close. Proceeds from the sale of real estate. So this is another popular one. Especially in San Diego, if you are a first-time home buyer, most likely you're buying a starter home, meaning that you're not going to be there for the rest of your life. It's kind of a stepping stone for you. So a lot of people stay there a few years, they'll sell, and then they get proceeds from the sale. So you could be netting let's say $50,000 of net, and then they put that money down towards another down payment on a bigger home. So you could use that money there. And we already went over this one. So these are just some other examples of non-acceptable sources of funds that you cannot use. So here's how the home buying process typically works. If you guys are interested in applying, this is kind of the process that you will have to maneuver around. So if you complete a loan application online, we get pre-qualified for a loan amount. We don't like to pre-qualify. Myself, I don't like to pre-qualify. I'll always pre-approve. Pre-qualify just means I just give you a ballpark idea of what you could qualify for. This doesn't really help anybody. If you are a serious buyer, you definitely want to get pre-approved, because that means that I have done my job and verified all your information, ran it through my desktop underwriting system. In some cases, I even send it up for underwriting approval. So then that way, when you are ready to shop for a home, you know exactly what you qualify for, and you're not just wasting your time and wasting the agent's time by going out on a pre-qual. You definitely want to get pre-approved. So you provide financial documentation, and here you go, get pre-approved for the specific amount. So this is what I do every single time, pre-approved. Once you're pre-approved, we'll get you a pre-approval letter. You hire a real estate agent. So a lot of people like to use people they know. If you don't know, if you don't have a real estate agent that you know, or you have no clue where to start, I can recommend a good real estate agent in your area, so that way they can start showing you homes. Once you find a property, you'll sign a sales contract for the property. This will be a negotiation between you and your real estate agent to find out, what is the best offer that you could put out there, so that way you get noticed. It's very competitive out there, so you definitely want to have an agent with experience who knows how to write offers and get your offers accepted. Sign your loan disclosures within 24 hours. So once your loan is accepted, we'll send you a loan estimate and disclosures. It's just a whole bunch of documents that you're going to have to look at and give you a loan estimate of how much your loan will be. Attend your home inspection. You're gonna go with your real estate agent and recommend. Sometimes it's recommend, or I recommend getting a contractor or somebody who knows about construction and just plumbing and stuff like that. So that way you can kind of check out if things need to be repaired. If they do, they have to submit a request for repairs. Like, you definitely want to look at roofing. You want to look at plumbing. You want to look at like the sewage under the house, all the plumbing underneath the house, because those are very, very expensive repairs. So you definitely want to catch those beforehand. Own your home. So once you own your home, or I'm sorry, what's it? Guild orders an appraisal. So I'll order the appraisal once your offer gets accepted. That just means that an appraiser is going to go out to the property that you got your offer accepted, to make sure that it's worth what it's selling for. The bank is going to loan you the property is a collateral that the bank uses, so they want to just make sure that it's worth what they're selling it for, because if it's worth less, then the bank's only going to offer you what the property is worth to the appraiser. So I could talk about this for like 10 minutes, but just know that there will have to be an appraisal that will be ordered, and this is just to make sure that the property is worth what they're selling it for. Your loan is approved and you sign the closing disclosure. So once your loan is approved by underwriting, you'll sign your final closing disclosure. This will give you your final numbers as far as what your mortgage payment will be, how much money you'll need down. You'll sign your loan documents. So once everything is signed, we'll send over all the documents to escrow, and escrow will you're going to sit down with a notary and you're going to sign loan documents. So you're going to sign probably like around 30 to 40 pages with pen and paper. So be ready for that. Bring a little ice pouch for your hand after you're done with this one, and then you get your keys. So this whole process, I mean, this by itself could take, I take about 3 to 5 days to do all this. It could take longer if I have to request more information. Finding your home, I mean, that can depend. I mean, you could take 30 to 60, even 90 days, depending on what you're looking for, if it's very competitive or not. And then the whole escrow timeline, this could take 21 days, 30 days. I had one earlier, 15 days before. So it's just whatever, I will talk to your real estate agent, and we'll find out the best amount of days that, or the lowest close of escrow that we can do it on. So yeah, this is the home buying process. So last but not least, if you are interested in applying for a home loan and you guys are ready to take that next step, This is what I will need from you. So if you guys are interested, send me a message. You guys can send me a message through Instagram. You can call me 619-361-3046. You can email me. Oh, it's right here. Here's my contact information. So if you guys are interested in starting the process, let me know. I'll send you an online application for you guys to start. I'm going to need all these documentation, all documents here. We'll need pay stubs for the last 30 days. We'll need W-2s and 1099s for the last 2 years. We'll need your tax returns, all schedules and attachments for the last 2 years. Government issued ID, last two bank statements for all accounts for anybody who's applying for the loan. This is very important just because a lot of people are afraid to show me how much money they have on their account. If you tell me you want to use only $15,000, we're only going to use $15,000. I have to be able to see all bank accounts because sometimes there's like IRS payments that don't show on the credit report. Sometimes there's car payments. Maybe your mom co-signed you or mom took out a car for you and it's not on your credit report, but you make the payment. So there's things I have to be able to audit your bank account. So you have to upload all of them and investment accounts. So if you do have a 401k, thrift savings account, any type of 401k account that you can take out money from, you definitely want to submit that because that's money that you could use. So that's pretty much it to get started. There are other things like if you're a VA applicant, we need DD 214, statement of service active duty. If you're divorced, we need your divorce decree or legal separation agreement. If we pay child support, we'll need court-ordered child support, gift funds. So this could always happen later. This doesn't have to be provided up front. IRS repayment copy. So there's little things here and there that if these are applicable to you, you have to submit these. If you're a homeowner, you're buying another home or something like that, we'll need your current mortgage statement, property tax bill, homeowners insurance, HOA. And if self-employed, very important. Self-employed, people think that just because they're self-employed, they can't qualify, and you definitely can qualify. It's just a little bit harder because you have to have 2 years of declared tax returns, and a lot of people that are self-employed, they just to avoid paying so many taxes, they'll expense a lot of things. So you could be potentially making $150,000 a year, but if you expense all these things and you only end up with a $30,000 net profit, that guess what? That's going to be your income. You're paying taxes on those $30,000. So that's what I mean, where it could be a little bit more difficult. And also, if you are making, if you're telling us that you make a certain amount of money, uh, uh, um, it has to be reinforced by your what a year-to-date profit and loss statement and your tax and your business bank statements and the balance sheet. So just know that there's just a little more extra work that has to be done on our end to just make sure that everything lines up with what you're saying as far as when you're self-employed. So, but yeah, no, it doesn't mean that you can't qualify. You definitely can, but it's just a little more things that we have to do. So we're totally digital. If you want to meet in person after you do all these things, I always like to start off everything doing digitally, just because the whole application process, calculating income, asking questions, and just it could take a long time, kind of a long amount of time. So I recommend you, if you guys are serious, do all these things first. Once I have all the financing down and you guys are pre-approved, then you guys can either come into the office or we can sit down and do a Zoom meeting. Just through COVID, I've been so used to doing Zoom meetings now that it's kind of become like my norm now because it's so convenient. You guys, there's no driving involved. I can pretty much schedule them at any time. So, but yeah, let me know. I hope all of this information was helpful and maybe hopefully it opened up your eyes and to see all the different types of options that are available out there. So if you are interested, let me know. I am here to help you guys out. My consultations are free. I don't charge anything. Even if you're just curious to know where you stand, let me know. I'm not going to charge anything for any of my services. So, but yeah, I hope this was helpful. And if you guys have any questions, feel free to contact me. So anyways, have a good day and talk to you soon. Bye-bye.